The Federal Reserve kept rates unchanged today on Wednesday, June 18th.
In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments.
What's next? Well, more rate cuts may be on the table, says Powell, but we'll find out what's really going on with the economy with our next guest, Lobo Tiggre, founder of the Independent Speculator.com. Welcome back, Lobo. Interesting day today. The markets are sliding a bit. Risk assets are down. The stock market is slightly flat and down. Bitcoin's down 0.5%. Gold fell almost 0.7%, 70 basis points. So that's a big move for gold. We'll find out what's going on. Thank you for coming back.
Always fun to talk with you, David, but I got to push back a little bit. You're going to find out what's going on. I'm a due diligence guy. People pay me to kick rocks. So you want to talk economics and the Fed. And so, yeah, like the Einstein joke, we'll give it a go. But remember who you're talking to.
I think Lobo is very humble and very modest. People can check out Lobo's conversations with me in the past below. He has a very good understanding of what's going on. But let's just take a look at what's happening right now with the Fed. I'll play for you this clip. Lobo, we'll respond together.
So you're saying that uncertainty has come down, the economy is moving at a solid pace, inflation has come down over the past 3 months, and this is all moving in the right direction. So are you indicating here that Americans should expect some sort of economic pain in the second half of the year?
I'm not saying that at all. From our standpoint, what I can say is that the U.S. economy is in solid shape. Inflation has come down. The unemployment rate remains at 4.2%. As I mentioned, real wages are moving up. It's a good job creation is at a healthy level. Unemployment, again, as I said, low. Labor force participation in a good place. So, and what we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that. Every forecaster you can name who is a professional forecaster with adequate resources and forecasts for a living is forecasting pretty significant. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs because someone has to pay for the tariffs, and it will be someone in that chain that I mentioned between the manufacturer, the exporter, the importer, the retailer, ultimately somebody putting it into a good of some kind or just the consumer buying it.
I'm going to stop it here. Wow. For many years since I've done this, I haven't heard Powell this strongly come out and vocalize his expectation for higher inflation. I know he's been talking about it for quite some time, but I think, to my knowledge, this was the first time that I've heard him at an FOMC meeting bit this strong with his language. But anyway, he seems a little flustered as well. What's your read on what he just said?
Striking. I mean, bearing in mind that this is the chair of the Federal Reserve, he's never going to say, "Oh my God, head for the hills." Right? That's not going to happen. So for him to even admit, and not just admit, but like everybody he knows is saying meaningful inflation is on the way. That's really quite striking. At the same time, the Fed also lowered its growth projection. So what he didn't say, but what this implies is a stagflationary outlook. They're looking at weaker growth and higher inflation. And okay, it's going to be passed through. He didn't use the word transitory this time, though he did last time. But that's clearly what they're thinking. Okay, it's the tariffs. It'll be probably one-off. So we don't want to overreact. At the end of the conference, he was asked, what about hiking rates? He's like, oh, no, nobody's even thinking about that. But that clearly says they're still in team transitory. That's where they're at, and that's why they're caught in this place. But that didn't work out so well for them last time. And if their own numbers, this isn't tinfoil hat Lobo, the independent speculator. This is the Feds and all those responsible people that he talks to. Are seeing this inflation on the way, and the cracks in the labor market that were also brought up. That's essentially stagflationary. And it's interesting to me that during Powell's press conference, you could see the markets bouncing around. Right when the FOMC statement was released, and this is a bit of tea leaf reading, but bear with me for a second. When the statement was released, basically nothing happened. Everybody was fine. There were still 2 rate cuts on the dot plot for this year. And the Fed didn't do anything, everything was more or less as expected. But then when Powell started talking, suddenly things went down. All 3 of the major U.S. indices dropped right away. And I think it has to do with this issue that you brought up, and the admissions that, you know, the number of times he mentions uncertainty and that they don't know what's going to happen, and that the economy faces headwinds, and that there is this inflation coming. Right. I think the markets were hoping for something more reassuring, but what they got was a bit of tough love.
Were you surprised that the Fed is not signaling cuts to the same degree that maybe they were in September? I mean, on the one hand, okay, let me just play devil's advocate here to what Powell said. On the one hand, yes, inflation expectations are all over the news, and as well as with my guests that I'm interviewing. But on the other hand, if you take a look at CPI, last month's data was 2.3% headline CPI. That's lower than the previous months by 0.1%. So yes, there's talk of inflation expectations, but the actual print is lower. And so shouldn't they be actually cutting rates right now? That's kind of my pushback. But anyway, I'll let you respond.
Well, so when they say expectations, they mean they're not talking about their own dot plot, and they're not talking about market pricing. They're talking about the ones they say are important now. Before Powell keeps moving the goalposts, right? Before the consumer expectations from the University of Michigan, that was a very important data point. But now that, or recently, it hasn't been supporting their conclusion. Suddenly, oh, that's just soft data. We don't pay attention to that. But the expectations that Powell says are important are these long-term ones. And he admitted that near-term inflation expectations are higher than they were before. And the very latest print was that they're down, significantly. People are less afraid of tariffs now. The shock is kind of worn off a little bit. But that was this last month. Since the last Fed meeting, the expectations are up. And so he dismissed that, oh, that's just the near term, the next year or two. But the important ones, those are the 5-year and longer ones. But it's interesting that he never specifies which data he's looking at. He says, oh, well, most of the long-term expectations are still well anchored around our 2% goal. Which ones? None of the ones I can see, even the University of Michigan one, if you look at their 5-year, it's still like 4% or so. It's like twice their supposed goal, not well anchored near their goal by any stretch of the imagination. So, what the hell is he looking at? I don't know. I don't know anybody who does know. So, it seems like, the constant goalpost moving is maybe to be expected, but at some point the market has to call BS on that. And this is where, the bond market vigilantes, it seemed like for some years that they were just asleep at the wheel, but recently the bond market has been upsetting the apple cart here. And it'll be interesting to see if there's some accountability going forward.
Well, let's get your expectations. Do you agree with the general assessment or statement that inflation from the tariffs has not yet been fully factored in to the data, meaning we're going to get higher inflation prints?
Yeah, I don't think it's been factored in at all. Even the mainstream admits that with all the stockpiling, the front running of the tariffs, and we saw that. The data is very clear on that. There was a huge amount of rushing to buy and import before the tariffs hit home. And so now you might say, well, gee, okay, so they bought all that stuff, but the inflation is coming, so why aren't sellers raising their prices now? Well, at the same time, you've got Trump lowering 145% tariffs on China to 120 to whatever it is now. We don't even know. You've got a deal with the UK, maybe a deal with the EU. There's an expectation that the deals that Trump cuts are not going to be at the level of the tariffs, which are supposed to be, it's funny, July 9, the end of the 90 days, prolongation, that's almost upon us. But there's an expectation that the actual tariffs are going to be less than the so-called reciprocal tariffs initially announced, right? The dog's bite will be not as bad as his bark. And so if you're thinking, well, it's going to be better, it's not going to be so bad, A, you don't know what's going to be, so why would you change your prices? And B, if you think it's going to be lower, well, maybe you eat that margin because it won't be so bad. And the other thing is we've had pushback from the courts. So if you're thinking, oh man, my input costs are higher, I got to raise my prices, but hey, maybe the courts will smack this down and I won't have to. Why upset your customers? Why raise your prices and lose sales if a week from now or a month from now, the courts or the deals might lower the tariff rates. So I think we've got front running in supply and inventory, and we've got very good reasons for producers and sellers, people along that chain, to hold off on raising prices if they don't have to. That's really a last resort. You don't want to do that unless you have to. So I'm not surprised that it's taken longer for this to show up. You asked me if I agree with the mainstream on this. Yes, I do. I do think that inflation from this is coming. But I understand the technical reason why Powell dismisses it. If you have a one-time increase, like the new rate is there, the higher price is there, and then it goes up. Inflation is a rate. It's a rate of change. So by definition, a one-time change in price, once that's in, there's no rate of change anymore. It's steady state after that. So you can say, oh, that's not just inflation. That's not inflation. You can dismiss it. But the reality is for the person who goes to the store, they don't care whether inflation is technically a rate of change or not. They go to the store and prices are higher. That's what they care about, and they're not going back down again. So on the one hand, technically I can say there's a reason for Powell to say what he's saying, but the reality is people aren't going to be happy when those prices go up. And the other reality that's kind of not acknowledged is, okay, that's this round. Well, what about, the responses, and what about the knock-on effects? They say, oh, the tariffs are one time. That's an assumption. They may not be. And we'll see. So I do think we're going to see this higher inflation, or this bout of inflation near term. I think that's coming. But I'm not so optimistic as the mainstream is that that's one off. And then after that, you've got the great big beautiful bill. You've got money helicopters in the air. I think all paths lead to higher inflation farther ahead. And really, ultimately, David, whatever the answer right now is, the bigger picture here is that Trump's agenda is inflationary. Doge did not save us $2 trillion. Sorry, I was all in favor of that, but it didn't happen, right? And we're raising the debt ceiling so it almost doesn't exist anymore. We're spending trillions and trillions. Maybe some years down the road, greater efficiencies, AI, who knows, might help. But for the foreseeable investable future, the outlook is inflationary regardless. And that's good for the commodities that you and I and our audience care about.
The silver price has broken out to new highs for 2025, and Silver 47 is a name worth watching. Today's sponsor, Silver 47, is a U.S.-focused exploration and development company with a district-scale silver gold-rich VMS project located in south-central Alaska. Silver 47 announced plans to merge with Summit Silver to create a premier silver company operating in the USA, and has grown its high-grade resource base from 168 million ounces to 246 million ounces of silver equivalent on a pro forma basis. Backed by a proven management team determined for success, it is well positioned to unlock serious value for investors. To learn more, go to silver47.ca/David Lin, link down below, or scan the QR code here. And be sure to review their cautionary statements, forward-looking information, and risk disclosures, which are available on their website and on SEDAR+. Speaking of commodities, yeah, I'll play for you another Fed clip in just a minute. But speaking of commodities, gold went down today, like I alluded to in the opening. Why did gold go down on the prospect of higher inflation?
Is that why it went down? Or
I don't know. I'm just saying, well, you and I are both talking about higher inflation. We could agree with Powell. He made a strong statement that inflation is coming, yet gold went down. We typically think of gold as an inflation hedge. So is that a little counterintuitive for you, or do you think gold's maybe moving on other forces
here? We've talked about that a number of times, David. Gold tends to lead inflation. So arguably, gold going to 3,500 a couple months ago led the inflation expectation that we're seeing now. So, right, I mean, you know this as well as I. If you correlate CPI and the gold dollar exchange rate, the correlation is terrible. It's not quite negative, but it's almost non-existent. And so, because gold tends to lead, so arguably the gold market sniffed this out in advance, and so now that it's here, it's not doing much. And okay, it dropped a bit. It really, if we're anywhere 33, 34, 3,500 in that range, that's a very high gold dollar exchange rate. I like to call it that instead of the gold price, because in my mind, gold is money, and it's like euro dollar exchange rate. It's a Forex question in my view. So I see the fluctuation as minor. I think really these days, what's happening geopolitically, the Trump agenda, and not even it's all Trump, but the weaponization under Biden before, the weaponization of the dollar and the central banks around the world diversifying their reserves into gold. These are mega trends that are happening right now, very supportive of gold. And it's interesting that, if we'd had this conversation a year or two ago, a big surprise by the Fed or a big statement by the Fed would probably have whacked gold a lot more. We'd be seeing $100 moves, something like that. But now it looks to me where we're at, the gold market is so well supported. There's such a strong bid under gold that little fluctuations like this, they just get bought.
You made the statement earlier that Trump wants inflation. He also, I think he wants a weaker dollar. Maybe that's two sides of the same coin. Are we suggesting that this regime is going to be perpetually bullish for gold in the next 2-3 years until at least Trump leaves office? Can we make that assessment?
I think so. Based on the remarks I just made about inflation. High inflation ultimately will be good for gold. If you don't correlate CPI and gold on the wiggles, short term, but if you pull back, this, my favorite chart in this whole question area is the long-term chart of gold since 1971 and the purchasing power of the dollar. And it's a giant X. So yeah, I think that's supportive. But there's also the geopolitical environment. And again, the central bank thing can't be overstated. I mean, I think you and I talked about it when it happened in 22. That was a big deal. And maybe we didn't want to go out and say, oh, yes, this is a complete game changer. Everything's going to be different after this because, once bitten, twice shy on bold predictions like that. But that was a really big deal. You've got not just Russia or Russia and China or BRICS, but you've got central banks of allies even saying, you know what, maybe we should diversify a bit out of the dollar. And sorry, Trump fans, I don't mean to be excessively critical here. It's just he's the guy in the White House, and Trump is upsetting the apple cart with allies. So if you're Canada, say for example, and your BFF suddenly is not ruling out war to make you the 51st state, do you really want your financial well-being entirely dependent on what's decided in New York and Washington? I think it's prudent for even your best friends to diversify it. So I think this is huge, David. This is a paradigm shift. And maybe the takeaway for this for our gold bug friends out there is that if you're worried about gold having gone so high, and you look at the chart and it's like vertical, it's reasonable after going screaming up through 2,000, 2,500 to 3,500 to worry about a pullback after that. That's what I would normally do. But if the game has changed, if we're no longer in the same context that we were before 22, then there's a case to be made that looking backward too much would be a mistake.
What's your assessment on what silver is doing right now? You and I haven't spoken about this subject since you were on the show last time, a couple months ago. Since the beginning of the month, June rather, silver's been on a tear, and interestingly, gold's been kind of flat all month long if you just take the last 2 weeks, while silver has been moving on its own. Is this just, so there's a couple narratives I'm hearing. One, silver's following something else, which I can ask you to comment on, or two, silver's just playing catch up to gold. But then if it is, my question is why now, right? Anyway, Exactly. I'll let you respond to it.
Yeah, why not? No, I agree. Good questions. I do think it's not just playing catch up. And by the way, if it is playing catch up, your diehard silver bulls will tell you that silver, and I agree, this is another statistical fact, is true. Just look, in a typical bull market, or no, in all past bull markets except one, silver has lagged gold at first and then more than caught up on a percentage gain basis at the end. The except one was the crash of 2020. So yeah, it's reasonable to say that at some point silver, statistically, the odds are that silver at some point will play catch up and more than surpass gold on a percentage gain basis. But that's the blow off top at the end of the market. So if that's the argument you're making now, that silver is going in that blow off top phase, you're saying this bull market's almost done. I don't see anything in the fundamentals to support that case. And the other thing is, silver, as you and I are speaking, and went back over 37, but that's the second time. A week and a half ago or so, it did it before. And there are a lot of silver bulls out there like, yeah, this is it. It's going straight to 50. And I got Rotten Tomatoes thrown at me for saying, well, maybe, but maybe not, and then it corrected, not in a big way, but it struggled. And I think what you just said in the end of your question is really important. When you see silver and gold moving in opposite directions, that's important to pay attention to. This morning, there was a headline, I think on mining.com about silver is outperforming gold as Mideast tensions, rise. That makes no sense to me at all. If it's the safe haven bid, if it's fear driving people into safe haven assets, then gold and silver would both be rising. So the fact that it's silver that has the greater industrial side that was moving up at the time while gold went down tells me that it's something else. And the other thing is that if you look at this last month, when silver went screaming up to 37 the first time, platinum, palladium, and even rhodium were moving at the same time. Other silvery, expensive metals, so-called precious metals, were moving at the same time. And then last week when silver pulled back and consolidated a bit, those other ones did too. So it seems to me that the argument here is something is going on. I don't know what it is, but it looks like it's coming from the industrial side, not the safe haven side.
Here's an interesting quote from Trump in response to what happened today with Powell. Okay, I will get Lobo's silver and gold outlook, so stay tuned to later in this interview. I know we don't give exact price predictions, but we could today. Let's start with this clip first, though.
Am I allowed to appoint myself at the Fed? I do a much better job than these people. So anyway, we should be 2 points lower. It'd be nice to be 2.5 points lower. We'd be saving $800 billion, $700 billion. That's a lot of money. Think of it for nothing, for absolutely nothing. We'd save $600, $700, $800 billion. We have, I think we're 38th now in interest. And we should be number one. We should be the lowest.
Well, there you go, David. A bunch of construction workers agreed with Trump that interest rates should be 250 basis points lower. QED, we're done here. The argument's settled, right?
He also wants to appoint himself. So,
yeah. Well, hey, that would save money. Fire all those hundreds of PhD economists they have at the Fed. I kind of like that idea.
Okay.
But, okay, this is interesting. I mean, to me, this is Trump being Trump. He's on camera. He is a TV personality, was long before he was president. And whatever you think about Trump, love him or hate him, whatever, I mean, he's not entirely ignorant. There is no way that he cannot know that the Fed dropping interest rates 2.5%. I mean, never mind a jumbo or a mega cut of, never mind 50 points or 75 points, but 250 points at once, that would tank the markets. That would signal absolute panic and mayhem. Oh my gosh, that would be such an emergency move that I don't think there's any way Trump doesn't know what would happen if Powell did as he suggested today. So he's saying it for his audience. I think this is just Trump being Trump, speaking to his base. And it makes sense. Oh, gee, if interest rates were lower, the debt would be better. But the consequences of doing that, he says, oh, well, we save $800 billion for what? For nothing, just for tweaking the rate. Well, it's not for nothing. If they did that, aside from the immediate panic reaction, the stimulatory effect, the inflation that would cut loose, I think, would be even more. And, Trump says, oh, I just got here and they threw eggs at me. Well, imagine the eggs he'll get if he puts somebody in the Fed, and actually, I'm not even sure him replacing Powell would help. The committee votes. So if you get somebody in there who's just a Trump puppet, who does whatever Trump says, and nobody else on that committee agrees with him, I'm not sure Trump gets what he wants anyway. And, that could actually be a good thing. Institutionally speaking, if the president couldn't just, browbeat the Fed into doing whatever it wants, I think the Fed should be abolished. Actually, but in terms of divisions of powers, I think the Fed should be able to stand up to the president. Anyway, my reaction to this is I think you can't take that at face value. Like they say, take Trump seriously, but not literally. And I think that new conventional wisdom is wise in a case like this.
I think Trump also called him a stupid person. Let me just play for you. This is a comedy hour at 3 p.m. Eastern.
See, I'm nice. Nothing works. He's like just a stupid person. But I don't expect anything. Maybe he does a little bit, but we should be 2.5 points. Remember.
Okay, all right. I'm going to stop it right there.
But that supports my point. If the president of the United States is complaining because nothing he does moves the chair of the Federal Reserve from his course, let's even say Trump is right and Powell's wrong, and Powell should be doing what Trump says. It says something about the institution that the Fed chair can resist that pressure. I in terms of statecraft and division of powers and the worry of concentration of power and overreach from the executive branch, I'm actually very pleased to hear Trump say that, Powell doesn't care about invitations to fancy dinners and won't listen to him.
Okay, Lobo, what is your expectation for ultimately Fed policy this year, and then we'll go back to markets?
Oh, well, let me get my magic 8-ball out here, David. All right. Okay.
Why is it in the box still? You mean you've been giving us these prescient calls without actually having to use these 8-balls? I'm kidding.
Well, I'm not sure everybody can. Well, that's a good. Well, maybe it'll roll off the desk.
Okay, let me ask you another way. They're expecting 2 cuts this year. Is that reasonable for you?
I think there's a good chance we get no cuts. Again, I'm paid to look at a rock and see if that really is pyrite, or maybe it's chalcopyrite in there. That's what people want to know from me. But I think that, it's somewhat contradictory for Powell to sit there and say everybody he knows sees this inflation coming, and yet the dot plot still has those 2 cuts coming for this year. And there's not that much of this year left. I mean, okay, it's only halfway through the year, you might say, but there's only so many meetings there. So, if Powell is saying on the one hand, we're worried about this temporary bout of inflation, we're in a wait and see mode. But on the other hand, we still think, our best guess is that there's still going to be 2. I mean, these things contradict each other. I suspect that they're probably going to sit on their hands longer. I think they're rightly more afraid of inflation than they are of jobs. And I think actually maybe this is what caused the markets to react so strongly. In his opening remarks, Powell said basically the same thing he always says, but then he reminded everybody that you can't have a great job market without stable prices. So he basically was saying that of the dual mandate, the inflation one is the most important one. So if he's saying the inflation part is more important, and he and everybody he knows is worried about this incoming round of inflation, I think that puts those rate cuts very much in question. Sorry, one more thing.
Yeah.
I don't know if you noticed this, but this was really wild. In terms of, we're going to wait for data, we don't know. I mean, it's not just the number of times he talked about uncertainty, David. Did you catch that moment when one of the reporters is asking him about dots and why they didn't move? And he basically said, we're just guessing. He said, and he said this before, but he said it strongly,
Oh, yeah.
None of us have any confidence in our dots. We're just putting them on there because we have to. Like, they ask us the questions, so we got to say something. And then he looks to the reporter, he says, well, what would you put? This is a fucking chair of the Federal Reserve. He's asking the reporter.
Like I said, he sounds very flustered today. Yeah.
Right? So wow. What kind of admission is that for, supposedly 400 PhDs behind this guy, and his best guess is, gee, I don't know, what would you do? That was to me really a striking moment.
Well, we shouldn't, as normal citizens, expect the Federal Reserve to have perfect foresight of the economy. Nobody does, right? I mean, I think one has to keep in mind that they get it wrong just as much as anybody else does, but they're policymakers. So I guess if they don't know, then what kind of tools should they be using, to make policy decisions? Well,
so it's an interesting thing that you asked that. It's sort of like there's tenure too. Powell's tenure is up in 9 months, but for those years, he's there no matter what. And if I get it wrong, one, I'll lose money because I put my own money where my mouth is, and B, I'll lose. So there's real world consequences for me if I greatly go in the wrong direction. What are the consequences for him? So it's kind of interesting. There was another moment, and it's funny. I'd rather talk about the rocks and the metals, but this meeting was so striking. There was another moment. I don't know if you saw this. It was very poignant to me, where one of the reporters said, Powell, don't you have a duty as a policymaker to level with the American public about, these major changes that are coming. We are at a time of historic change. And doesn't the Fed, shouldn't they be saying something about what this means and how this changes? And Powell basically said, yeah, but we don't comment on public policy. That's for the president to say or for Congress to say. But yeah, these are really historic times. And that's it. He didn't go any further. He didn't really provide any guidance. He didn't say, therefore, here's our framework. I thought it was interesting that question came up. Nobody asked him about stagflation or any of the things I would have asked about. But this one thing, if I've written that Trump, his agenda isn't just about tariffs. The tariffs are a tool. And it's not just America first. It's Fortress America first. He's not just trying to build back car manufacturing jobs. He wants America to be able to use Doomberg's phrase, be strong and self-sufficient in military adjacent industries. And so to do that, to reindustrialize America is a major, major, major change. We basically outsourced our manufacturing and we were okay with that. We were supposed to learn to code instead. To go backwards and to reindustrialize America and therefore change the entire global economy, I think is as big an economic change or an agenda as Richard Nixon slamming the gold window shut. It is a major, major shock and change to the entire global economy. And this reporter asked Powell, shouldn't the Fed be saying something about this? Okay, maybe you don't second guess the president or Congress, but this is a big deal. Shouldn't you be talking about it? And Powell essentially dodged the question. I thought, kudos to the reporter on that one. And shame on Powell for not being more forthright with the American public on it.
Okay. I will come back to Rox right after I play for you this clip. I think this is what you're referring to. Let's just share it.
Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast are very high. How do you get to a place where you have the confidence in the outlook for, say, inflation and or growth or the unemployment rate? How many months does it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we're going to learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see whether, to the extent to which they do over coming months. And I think that's going to inform our thinking, for one thing. In addition, we'll see how the labor market progresses. So at some point, it will become clear. I can't tell you exactly when that will be. And meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength, and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know.
All right. So
no, that was a different one. I think that was Steve Richmond from CNBC. It's kind of embarrassing that I'm starting to know these reporters' names. This was somebody else. I think New York Times, an older gentleman. But this clip that you paid, I mean, it's part of for the course of what I'm saying. It seems totally disingenuous from me to say, on the one hand, we're in the right place, and then to say we don't know what the heck's going on. We need to learn more, and we'll learn more by this summer. Like, these things are mutually exclusive. And okay, he didn't say we're absolutely convinced we're perfectly right, but he stressed again and again how strong the economy is, how great the unemployment rate is, and how we're in a good place, and so we can afford to be patient and learn more. I think there's a contradiction in what he's saying. Oh, and by the way, the unemployment rate is still low. It's at multi-decade lows. He knows, he has to know, as chairman of the Fed, that the U3 unemployment rate that we now look at, which is 4.2%, is not the same unemployment rate that we had those decades ago, which is almost tracked by the U6 unemployment rate, which is much higher. If we still looked at unemployment now as we did in the 60s or 70s, we'd be looking at levels. I don't know what the last U6 rate was, but I remember being around 7 last time I looked. Since nobody pays attention to it, I don't track it every day. but it's much higher. So, and he has to know that. All these people out there who talk about, it's one thing if it's just Joe Sixpack around the bar looking at Powell on TV, but it's another thing for the chair of the Federal Reserve to refer to times in decades past when the yardstick was different and never ever mention that. I just can't see that as anything other than dishonest.
Gold and silver. Let's move on to finish your thoughts on gold and silver, and then I want to talk about uranium for just a minute. So gold and silver chart on my screen right now. Year to date, gold's up 28%, silver's up 24%. Silver started outperforming gold in the last month or so. Silver up 13%, gold up only 5%. This is what we were talking about earlier. Let me just leave this year to date chart up there. Again, bull market, silver should be outperforming the entire year. Hasn't done that. Do you think silver will finally beat gold for the remainder of the year, meaning by the end of the year, December? What's your prediction for what will be the stronger metal?
Don't know, but let me be a little bit more helpful than that. And people may not like this help, but I've tried to be as helpful as I can. And here's the deal. This silver breakout is significant. This is a significant move. Even Darth Silver admits that. If it continues, then I think the answer to your question is silver outperforms and increases my urgency to add more silver to my portfolio. I'm not short. I'm not bearish. I have some. I wish I had more. And I probably will make greater efforts to buy more silver, add more silver if this breakout continues. But remember what we said earlier in this conversation, the move in silver came at the same time as platinum and palladium and rhodium, and they all rolled over at the same time. I haven't checked today to see if when silver went back to 37, if those other silvery metals did as well. But if silver is outperforming gold this month because of its industrial side, then more Trump shock in the months ahead as we figure out what these tariffs actually do to the economy would be a headwind for silver that gold doesn't face. And if that doesn't happen, if that's not what's going on and silver leaves the other metals in the dust and there's something very silver specific, shorts being liquidated or whatever it is, if this is an unusual time to ask a question like this, David, what I'm saying is we might know in the next week or two, if this continues and it's something unique to silver, then I think that becomes investable. It would change my marching orders, what happens in the next week or two with silver. And if it confirms, that's very bullish, increases my urgency to buy. If it doesn't, then it tells me, let's wait for Trump shock and probably start piling into silver again more about the same time I start buying more copper stocks.
Copper stocks. Tell us about copper. Why copper stocks?
It's Dr. Copper. It's one of the, people are saying, oh, it's the new oil because of the green transition. Well, never mind the green transition. It's always been Dr. Copper because it's an essential economic, it's an essential mineral for all kinds of economic activity as much as oil or iron is. So if my outlook is inflationary, as we described earlier, then that's bullish for commodities prices as a class. At the same time, copper, unlike oil, which is in a bit of a glut and facing not a bit of a glut, it is in a glut. And I mean, just think about it. We've got Iran and Israel going, the gloves off, going at it, full tilt, open, this isn't just a skirmish. This is a major war in the Middle East. If you had told me this would happen a year ago, I would have thought oil would be triple digits. And in fact, my power just went off, David. In 2022, when October 7th happened.
This is why we need more copper to build more wiring for Lobo's apartment. All right. Well, Lobo's power went off. We'll be back. Okay, there we go. Lobo's back. All right. There. Okay. Please continue. You were telling us about copper.
So, copper is essential. An inflationary environment is bullish for the price, but unlike oil, in which we're in a glut situation and OPEC is quadrupling, it's ramping back up again, all this stuff. The war may make oil prices spike more. It's amazing that it hasn't more. But the fact is that oil is as essential as copper, but it's in a surplus right now, whereas copper is not. And it's not just tinfoil hat Lobo and his crazy independent speculators. It's mainstream economics and engineering firms researching this. Everybody is projecting a widening gap in copper supply. There's not enough copper coming online. So if you've got a supply shortfall and you've got price pressure, I mean, it just looks like a no-brainer to me. I really, really like copper. And so we got onto this from talking about silver. I'm bullish on silver, but if its industrial aspect is a headwind in the near term, as soon as that headwind goes away, then I'm buying copper for the reasons I just gave. I love copper. And it would make sense that the industrial side of silver would then become a tailwind. So it would be all the more reason to pile into silver more as well.
Anyway, the war is happening right now between Israel and Iran. The Middle East is heating up. President Trump said today he may or may not strike Iran. I may do it. I may not do it. I mean, nobody knows what I'm going to do. He said on the White House. He said at a White House press conference on Wednesday. So, I don't know if this has any direct investment implications for you for the commodity side, besides maybe oil.
I think the most important takeaway from this is actually not an investment one, but a reminder that gold it's real money. It's a physical asset that you can own, a financial asset that you can own and you can be long, for which there is no counterparty risk. There is no short against your long. And it's striking to me, David, as you and I are speaking this morning, a video came across my desk of people purportedly in Tehran trying to flee the capital, and they're going to get money out of their ATM, and the ATMs are all dead. There's no electricity. They can't get any cash, can't pay for gas to fill up the car and flee the city. Horrible nightmare scenario. And it was, to me, that was a reminder of why you don't have to be a gold bug and put all your savings in gold and get a golden mattress or anything like that. But if you have a little bit of your savings in gold and silver to make change, in case of the worst case scenario, I sleep better having gold. In a situation like this, we're in a war scenario right now where the US may get drawn in. There could be retribution. And okay, Iran can't defeat the United States on a battlefield, but they could certainly send proxies in to bloody our noses, maybe even on the home front. Who knows what could happen? Scary things could happen here, David. In a world where things could get out of control, I think it makes perfect sense to have some kind of stash, a little bit of insurance. And you know what? Hope not to use it. If I have fire insurance on my house, I sure hope I never have to claim that insurance. So I think this is maybe moments like this. Who knows how the war is going to play out? But it's a reminder that, and sorry, Bitcoin fans, but if you want something governments can't print, but you also want something that works when the electricity goes out, you're looking at gold and silver.
Can I say that gold and silver are like insurance products, like you say, but gold and silver miners right now are the chips at the casino that if they land on the lucky number, I'll get rich. Can I use that analogy?
There. Yes, that's absolutely right. That you're basically paraphrasing Doug Casey and what he taught me all those years ago, decades ago, right? You buy gold for prudence, and you buy gold stocks to speculate for wealth creation. Completely different assets.
Doug Casey, I remember he came on my show a while ago, and he said that there's roughly 2,000 or so junior mining companies. 99% of them are garbage. I'm paraphrasing. He used stronger language than that. But first of all, do you agree with that analysis? And second, how do we then, as investors, make the decision to pick the 1%? Besides, of course, subscribing to your service, which everybody should do.
Due diligence matters. Stock selection matters. I wouldn't go with an ETF in this space. I mean, okay. Let's say I'm bullish copper and I don't want to buy the stocks. I just want some copper. Well, there's an ETF for that. Okay, fine. But if I'm seeking alpha, right, I'm looking for that hockey stick. There is no substitute for due diligence. And sorry, but you did go there. So I got to say, and this is partially an answer to your data there. I have a service called My Take. It's not a regular newsletter. It's actually a database that has about 1,000 resource companies in it right now and growing by request. And the request list is almost 1,000 long as well. So that tallies up with Doug Casey's number. We'll see how many of them we get to. But what's interesting to me is I would have thought, like Doug said, that each company gets an independent analysis from me or my team. It all comes through me. and there's a thumbs up or a thumbs down. There's a thumbs up or a thumbs down. And I would have thought if you had asked me that there would be maybe 1 or 2% get thumbs up and then the rest of the deck all gets thumbs down. But there's actually about 10% thumbs up in my database. So out of the 1,000, okay, 900 are thumbs down. But it's the fact that there's 100 that have thumbs up surprises me. And my explanation for this is that my readers are maybe smarter than the average bear. They're asking about good companies. And that's why I can't prove that. But the answer to your question is I am surprised, maybe even shocked, that there are so many thumbs up in the 1,000 companies that my team covers.
Right. And just generally speaking, without giving specific names, just what is your process for A to Z? There's a project here, and then you're giving a recommendation to look into it or buy it, A to Z.
Well, that could be a whole
What's that
hour-long
process?
conversation. But basically, I am a due diligence guy. I will travel. I will send somebody on my team to the field to look at the rocks, verify the story. And, okay, I mean, there are limits to how much we can do. And we can't travel to look at every project for every company. What I can say, though, is that, our claim to fame, as it were, is it's independent. There is no amount of money any company can pay me to give them a thumbs up, and they should be a thumbs down. But anybody can do parts of this. Like you can go to the company's website, download their PowerPoint, and then start asking questions. You can go to PDAC or one of these shows and meet the CEO, look him in the eye and ask him how much is that going to cost and how much do you have in the bank. And if he can't answer these questions, you've got your red flags there and a reason to keep walking.
Give us an example, again, without needing to give any specific names, but give us an example of maybe a company that was an obvious red flag, an obvious thumbs down rather, right off the bat.
Okay, so I remember one. Oh, I don't know. I'll do my favorites, but here's the truth. Okay, I remember when
just
I
so
went
we
on
know
the
what to look
hindsight
for.
trip, and it was like the most disorganized mine site I'd seen. There was not just like piles of stuff here and there and all, but like mixed up. It was like a garbage heap. And the geologist that was showing me around was complaining about senior management the whole time, and it was just an obvious sign of not a quality operation. And so I went home and we had it in the portfolio. This was back in my Casey days, and we sold it at a modest gain, I think. And here's the thing, David, eventually that stock basically went to zero before, to being, in administration and all that. But before it did that, it went 5X and then it went to zero. So I was right. But I was out early. That's just the true part of that story. But at the end of the day, it was true. The place was a mess. The hype sent it higher, but then ultimately, reality had something to do. Let me, to answer the question for what people can do for process, the main thing I would say is be skeptical, ask questions. And even if you don't hire me to help with the due diligence, you can hire somebody else. You can go to a consulting geologist and ask them, what do you think of these results? If you're going to deploy a serious amount of cash, it's okay to do that. So be skeptical, ask questions, push back, don't be passive. As far as me and my team, I will say this, there's a report card. If you go to the website and you do a little search thing for a report card, you can see that there is a significant difference between companies that get thumbs up and thumbs down over the course of the year. The thumbs up obviously outperforming the thumbs down. So despite my story there about the stock going 5X before it cratered, I think the evidence suggests that my team and we do know what we're doing.
Good. Well, uranium. Let's finish off there. You told me offline you like uranium, or maybe you don't like it. I'm not sure. You told me you want to talk about it.
No, I'm very big on
uranium.
I'm a fundamentalist here, and the fundamentals have been positive for a very long time. In January of 24, it kind of got ahead of itself. It went up over $100. And I got to say, David, at that time, I didn't make friends amongst the uranium bulls by saying, hey, a bit of a correction would not be unexpected here. And we got that. And so then about a month or two ago, I said, look, it looks like it's carving out a bottom. The technicals were starting to align with my bullish fundamental view. So I started talking about buying. I put together a shopping list completely composed of uranium stocks. That's how bullish I was. But now it's happening. So the short answer to the question is fundamentals are there, technicals look good, and on top of this, we got Trump, who's not just helping with mining in general, but very specifically, he got religion on nuclear power. He wants to see more nuclear power, advanced nuclear power, regular nuclear power. He wants to expedite permitting, and I think this is highly material. This for specific companies that are obviously beneficiaries of what Trump does. I think this is investable. And just real quick, people say, "Oh, well, what if the next president comes and reverses the executive orders?" Well, that's 3.5 years from now. So if you've got a shovel-ready project, you can build that mine before that could happen. Or if you're just waiting on a permit, you get your permit, you move forward. So I do think that the sector looks great, and I wouldn't overpay for them. I wouldn't chase everything, but I would look at companies that can benefit from what Trump is doing, because that is a clear and I think durable tailwind.
Okay, excellent. Thank you very much, Lobo. Excellent updates, very thorough analysis. Where can we find your due diligence?
There you go.
All right, pretty simple enough. All right. The URL right above Lobo's head and also in the description down below. Click directly. Thank you very much, Lobo. Good to see you as always. We'll see you again soon.